Hello and welcome to the show that discusses the most important issues of the day. You're watching The Big Picture. The rupee may touch a new low of 57 to the US dollar in the next 3 months. That's according to some forecasts, while other polls have predicted that the rupee might oscillate between 52 and 55 to the US dollar. The currency fell 1.3% to 53.85, a closing level last seen in December. The all-time low for the rupee against the dollar is 54.30, and that's on December the 15th. The rupee, which has fallen 7.2% since the budget, now stands out as a weak currency when compared to its peers such as the Chinese yuan, the Brazilian real and the South African rand. All these currencies have appreciated this year thanks to current account surpluses and relatively steady economic fundamentals. India's current account deficit is 4.3% of GDP, far worse than the generally acceptable levels of around 3%. Now, Diviri Subbarao, the governor of the Reserve Bank, stepped in this week to stem the fall. The central bank is believed to have been active selling dollars in the past few seasons. Whenever the rupee approaches the psychologically key 54 against the dollar level, today the RBI asked exporters to convert 50% of their dollar holdings overseas in exchange earners foreign currency or EEFC into rupees. The RBI has also asked banks to restrict their net intra-day open positions in order to further stem speculation in the markets. Traders expect this measure to have a positive effect on the rupee in the short term, but the long-term outlook, I beg your pardon, remains predominantly bearish. Tonight on The Big Picture, we discuss the weakening rupee and the underlying danger that the currency might fall further. The question that we put to our eminent panel tonight is whether the steps taken by the RBI, are they enough? Are they going to stem the alarming slide of the rupee? Or is the RBI just postponing the inevitable? I'm Athar Khan, and to discuss the issue on the panel tonight, to my extreme left is Pinaki Chakraborty from the NIPFP, Priya Ranjan, welcome back to the show, Managing Editor of the Financial Chronicle, as well as Ajai Sahai, MD of FIEO, that is the Federation of Indian Exporters Organization. But I'd like to start the show, if I could, with Pinaki Chakraborty. My first question, sir, would be the rupee lost 4.5% this quarter. How much of the slide do you attribute to recent happening in the past, especially Standard & Poor's downgrading us from BBB negative to the outlook being negative? How much of that, of the rupee slide, do you attribute to news and developments like that?
Yeah, I think we have to look at the larger picture of the macroeconomy. Now, if we talk about the macroeconomy, the basic fundamentals of the economy is not bad. But if we look at the real sector, that means the GDP growth and things like that, they're reasonably well compared to world standards. What is happening in Eurozone and in the North America, India is doing reasonably well. But I think when you look at finance and the way the finance looks at India, there are problems. Problems in the sense that you have a very high fiscal deficit, and as you have mentioned in your introductory remarks, that there is a high current account deficit which is creating problems. And these problems are the reasons why our rupee is weakening against dollar. And that trend probably would continue for some more time to go. Now, also you have to look at some of the policy flip-flop that we had in the last few weeks after the budget. You had GAR, that created tensions, and now you have taken it off, and then you had also issues like other concerns with regard to the how RBI would be managing the exchange rate in the next few days. So those issues are also giving a signal that we really do not know what we are going to do for the next few months. So that also is creating problem. Now, if I may attribute this to the finance only, I can get a reason that yes, the rupee is going to get weaken further. But if we look at the real sector and if we look at the larger picture, I think over time, if the inflation rate comes down and your interest rate also starts gradually coming down and the kind of signal that we have got, I think in the medium term, maybe in the 6 to 7 months time, actually we'll see some stability in the foreign exchange market. And before that, I don't see this is happening.
Right. Do you agree, Priya Ranjan, that the policy flip-flops that we've been experiencing after the budget especially are partly somehow responsible for this bad slide in the rupee?
Yes, partly of course, insofar as foreign investors, their confidence is concerned. You know, it creates uncertainty to that extent. But that's one of the very minor reasons if you look at the exchange rate, what's happening on the exchange rate side. You know, the fundamentals are wrong. So there I don't agree with Mr. Chakraborty. Fundamentals are wrong to the extent that, you know, they are even by some parameters worse than the 1991 situation.
Right. That's been compared to this current crisis.
When we had a massive foreign exchange crisis. Now, of course, situation, the economy, the size of the economy and everything else is quite not comparable. But if you look at some of the basic parameters, the twin deficit that we are talking about, we are talking about
the fisc and the CAD.
Yes, the current account deficit, external current account deficit, it was 3% in 1991 and it is between 4 to 5% now. If you look at the fiscal deficit, they are comparable. In fact, the current fiscal deficit, I'm talking about the combined fiscal deficit of the center and the states.
The states, yes.
Put together, the public sector fiscal deficit today is 9% or even in double digit. Now, that being the case, and with an inflation being higher compared to our trade partners, fundamentally, the rupee has to be weak. So, I'm not surprised by the depreciation of the rupee. Now, the rupee will, if these parameters remain as bad they are or worsen, then the rupee would be depreciating further.
We could see a further slide is what you're saying.
Escape from that.
Right. Fair point. So let me come to Ajai Sahai and ask you this. The current account deficit, the CAD, is of course one of the main drivers of this situation that we find ourselves in. The rupees keeps sliding further. I think it touched a new high of around 54 to the dollar. How far do you think is the CAD obviously, like I said, is the biggest main driver, but do you think some external factors are also involved? Like, say, for example, Kaushik Basu, the chief economic advisor, says that we are watching the Eurozone carefully, and if it falls, if the Eurozone falls out, we'll have another impact on our economy. Do you think external factors are also responsible for the rupee sliding?
Definitely, I think it is a combination of the external factor as well as the domestic factor. Everybody is seeing what is the development in the Eurozone, and with the change of government in 11 countries, I think this is very important development, and we have to see how the things develop now. But I think the main issue is the mismatch between the supply and the demand of the dollar. Right. Once you have a trade deficit of $100 to $85 billion, you require that more and more supply of the dollar should take place, which is not happening. FII is not pouring money into India. On the FDI front, of course, the situation has improved a little. But
let me just interrupt you. You'll continue after this. I just want to give our viewers one figure that I have in front of me right now. Now, funds based abroad have cut holdings in Indian stocks and bonds by a total of 781 million in the month throughout May. That's just one figure that I wanted our viewers to understand. Sorry, please continue your point.
So, basic issue is that if we are able to reduce our trade deficit, that will be a positive sign. One way could be if the oil prices soften up, definitely you are able to manage your oil import in a better way. The good news is that on the gold and silver, there is a 33% drop in the recent figure which the Commerce Secretary has announced today. If the government is able to allocate the coal mines, then definitely there may be cut in the coal imports also. On the export front, I'm not very optimistic because the situation as is developing, I don't foresee a growth of more than 10 to 15%. The Commerce Ministry has recently released the data for April, which shows just 3% growth. So I think the more efforts need to be taken on the import front in the present scenario rather than considering your exports. Of course, we have to look at the opportunities in the export field also. But unfortunately, the growth in even the emerging economies is slowing down. And with that happening, I think whatever diversification strategy which we have adopted, which has yielded result in the past, may not produce the same kind of result.
Hold that thought, sir. We'll come to the current account deficit and what the RBI is doing to take some action against the sliding rupee. That's after the short break. We'll take a short breather right now. Don't go anywhere. Lots more to chat on The Big Picture tonight. Welcome back. You're still watching The Big Picture, and we just discussed with our panel what options really does Pranab Mukherjee and his team at the Finance Ministry have to actually balance the current account deficit. That, of course, is one of the major problems, and experts see that as one of the main reasons why the rupee is sliding. Let me come to you, Pinaki Chakraborty. You heard what Mr. Ajai Sahai had to say. As an economist, what options does Pranab Mukherjee and his team really have to actually make some sense out of the CAD right now? It's all over the place.
Yeah, there are a couple of things. One, I just want to make one important point. That point is that we have, because of the high current account deficit, we have been always comparing this with 1991. I think that panic button, should we be pressing now? I have a question. I have my own doubts because I think the economic fundamentals are much more strong than what it used to be in 1991. Right. So far as the level of fiscal deficit is concerned, it has to be seen in a context. The context is the global financial crisis. You gave fiscal stimulus, and that stimulus also has helped you in growth. So now you need to bring it down in the medium term to the level of 6%. Now, if we look at the center's fiscal deficit, it's 5%. State's fiscal deficit, not above 3. So taken together, it's around 8%. We have lived with much larger fiscal deficit. The biggest worry is the current account deficit. Now, if we look at the current account deficit also, much of this will have to be attributed something which is beyond the control of the domestic economy, like your oil prices going up. And also, the gold import. The gold import in the last year is about 2% of GDP. So the point is, now you had tried to restrict gold import by imposing taxes. Now you have withdrawn again that. So the point is that structure of current account deficit will have to be seen, how it can be controlled. Now, one of the things that RBI is doing, those are going to help only at the margin, like you are trying to attract NRI deposits and all. So fundamentally, that is not going to work. So one thing that you need to control is that you have to control your fiscal deficit so that your domestic absorption comes down and you also have options for export. And also, second thing that one has to see is that what happens to the global situation? What happens to my export demand? Unless there is demand growing up in the Western economies and in North America, you really cannot have a huge current account deficit through export growth.
Right.
Now, if you want to control import, that will have an adverse effect on growth. So it's a very tricky situation.
Right.
Now, one has to see how the domestic economy interacts with the global economy and how the global economy is going to interact with the domestic economy and how it improves in the next couple of months.
True that, sir. Let me come to Priya and Raj. Let's talk about the RBI's measure that have just come in. Today, I think it was today that the RBI announced that exporters, I'll come to you on that as well, but let me come to Mr. Dash first, that they have to convert 50% of their overseas holdings of dollar into rupees now. They've taken one more step about the intraday opening. What do you make of these steps? Do you think that's pretty much all that Mr. Subbarao can do right now? And how do you, what sense do you make of these steps as you see them?
The sense that I make is these are desperate steps. These could smoothen out the volatility that we have experienced this week or this fortnight.
So you're saying it's a short-term thing?
It's a very short-term thing, and it's not going to address the fundamentals that we discussed. But this kind of a measure, particularly restricting the export earners or the foreign exchange earners foreign currency account to 50% now, I think sends out a very wrong signal. We must make up our mind whether we are even the rupee, whether it is even convertible on the current account or not. After 15 years, that rupee became convertible on the current account. If you have allowed exporters to keep their foreign exchange earnings in foreign currency accounts, why is it, you react in a knee-jerk manner and suddenly impose a 50% restriction?
So you're saying they're hitting the panic button just a little early?
Yes, and it of course takes away the flexibility that exporting companies have from IT to textiles to gems and jewelry to everybody concerned. Now, these companies have hedged their foreign exchange earnings. They have made their plans for the next quarter and the quarter following it.
True.
Now, suddenly RBI reacts to a given situation and restricts it to 50%. I don't think that is done. These kind of policy decisions are what give a very wrong signal and create a crisis of confidence.
Let's get a picture of what the exporters really feel. How are the exporters taking these steps, first of all? Give us a sense of how exporters are taking.
No, in fact, what RBI has announced today, one of the measures which they have taken that first you have to exhaust the money which is lying in the EFC before you buy the dollar for import. We totally agree with you because if you have balance available with you, you should not go to the market. But the capping, where they are saying that only 50% can be retained, is something which will affect some of the sectors which has a very high import intensity. For example, if you are looking at sector like petroleum or gems and jewelry, their import intensity is 90%. For sectors like plastics, electronic hardware, chemicals, import intensity is 60% or more. So if you are asking the exporter to sell 50% of the money which is getting as exports, you are forcing those category of exporter to buy dollar from the market. And you know there is a difference between the buying rate and the selling rates that will put additional pressure on the exporter. What I personally feel that all these measures have been announced by the RBI in past few months, including the freeing of the PCFC also. RBI is not keen to pour foreign exchange into the market. They have seen that from September 2011 onward, they have poured around $20 billion in the market, which has not yielded the result. So they have revisited the strategy. They are coming with these kinds of measures, but I don't think these kind of cosmetic change is going to address your prime concern.
Brilliant, Nash, what other sectors? He mentioned gems and jewelry and other sectors as well. What other sectors will have to do a lot of work to comply with these directions that the RBI has given? Do you think IT will be affected at all?
Yes, means the entire, he spoke about some of the commodities sector, the mercantile trade. But even in the services area, now most of our IT companies, they do their foreign exchange planning. And since rupee has been volatile in the last couple of years actually, more so, they have done their hedging. And now that suddenly this kind of a steps comes in, that's going to take away the flexibility that exporting companies have had. So it's not going to address the fundamentals. The fundamentals, I will take the one point that Mr. Sahai and another point that Mr. Chakraborty mentioned. Those are the ideas that we should be working on. And I don't think it is Reserve Bank of India for everything that the rupee, there is a depreciation of rupee, so in Reserve Bank of India has to take the steps. Inflation is soaring high, so Reserve Bank of India has to come in, and the government does nothing. Whereas the problem lies with the government. I think fundamentals needs to be addressed, and those fundamental problems, what is it that we are basically trying to see? Like Mr. Sahai mentioned, there is, if you are looking at the foreign exchange market, there is a supply demand mismatch for dollar. Okay. Now, so we should get more dollars. If we get more dollars, to that extent, we will be ensuring the stability of the rupee. How to get the more dollars? Like Mr. Sahai said, you have to encourage exports. One, or if you have a current account deficit gap, you ought to have the financing of that deficit in a way that cannot be by taking short-term debt. Today, 70%, the danger that I was pointing out to is not just because the current account deficit is between 4 to 5% of GDP, but the way it is getting financed is dangerous. It is getting financed 70% of it by short-term borrowings.
Fair point, sir. Staying on the RBI measures, let me come to Pinaki Chakraborty and ask you this. The last time RBI intervened, the rupee did pull back. It came down to 49 and thereabouts, that level. Do you think the current set of measures, these two measures that the RBI has taken today, one telling the exporters to convert their 50% of their holdings, foreign holdings into rupees, and the other one on the intraday opening in the market as well, do you think it has enough teeth to pull back the rupee from the current situation it finds itself in?
I think it will only work at the margin. I'll agree with the panel that this is only work at the margin. Ultimately, RBI will sell dollars. I will pump in dollars.
There is a school of thought that said they've been actually doing that for a while.
No, they will do it more. That's what I'm saying. They will do it more and would stabilize at a level of 55 or so for some times. But and this I would consider as a buying time for the finance ministry to see that the fiscal deficit goes down or some situation improves. But I think RBI's reaction, if we talk in a larger sense, I think has been knee-jerk, whether it is inflation management or exchange rate management in the last couple of years. I think they're very scared of something which does not exist. Because inflation phenomena, you have increased multiple times interest rate, inflation hasn't increased, it has adversely affected growth. That growth in turn affected your export. So this is macroeconomy is not segmented approach. It's an overall. So you take a wrong policy decision in one sector, it affects the rest of the economy. And we are now seeing it in the foreign exchange. But also to be fair to the government and to the RBI, one also has to see the external situation. External situation is extremely
something that
volatile.
is out of our control
and
out of our control. Hold that thought, sir. We'll come back and talk about the future course of action that the RBI should take and what the future holds for the rupee as well. We'll come back after a short break. Lots more to chat on the big picture. Stay tuned. Welcome back. You're still watching The Big Picture. Let's dive straight into the discussion. Mr. Chakraborty, let me come to you again first now. What is the next logical step that you see the RBI taking? Is it going to be gold imports, like everyone seems to be talking about, some action on gold imports? Do you think the market should expect something on gold imports soon?
No, RBI really cannot do anything on gold import because it has to be discouraged. How do you discourage? You discourage to the tax policy or unless the gold demand comes down. RBI cannot come and say that you don't import gold.
Do you see any action on where the finance ministry, maybe on taxes or customs and levies and duties?
No, that I don't see happening. That will be too naive a policy step to take. That I'll now increase my customs duty. That's not the way the fiscal policy works.
Right.
I think fundamentally what they should be doing, they should try to reduce domestic absorption and try to create export demand. And the policies of RBI as well as that of the government should be directed towards that. Now, how it would result in higher export demand in the global market, that would depend on the global situation. Now, also you have to understand the global political situation. Now, Holland has said that I don't bother about fiscal deficit. I will bring in fiscal stimulus to promote growth.
The correct socialist line that he wants to take.
Correct socialist line coming in. So how that would play out in the Europe, one also has to see. But, you know, if we also think of India as a country which has a larger market, and if our growth improves, and the growth is largely domestic demand driven, and if there is something happening on the oil front side, you will definitely see the oil prices reducing. You will see a very different kind of an current account deficit than what we have. Also the question of invisible transfer. Nobody is talking about invisible transfer. Invisible transfers in the form of remittances have substantially declined after global financial crisis. And that is not going to improve immediately. So that is another area of concern that remains when we are talking about current account deficit management, and which is not under the control of RBI or the finance ministry.
Absolutely. Do you agree, Mr. Dash? Mr.
You know, let's not overplay the global factors over which we have no control. We can't do anything about it. So couple of things that we can do about, I would like to focus on that. You know, we were talking about the gold import. Last year, $68 billion of gold was imported. Why was it imported? It was imported because people in India are investing in gold more than in financial instruments.
They see it as a safe investment.
Why were they investing in gold? Because financial instruments were giving a negative rate of return because of the high inflation. So what was happening is, like our companies are investing abroad more than they're investing in the domestic economy, even households are investing in gold, which is another way of investing abroad, because all the gold we are importing, we do not produce our own gold. So one thing is, we have to see that how the investment environment in our domestic economy can be improved.
Right.
If we do that, that is one. The other point I would quickly like to point out is this main factor of oil. Now, on oil, we have, you know, the twin deficit, that is the fiscal deficit, that the government's budget deficit that is running, and the current account deficit. Both are because of oil. There we must take certain steps, and the steps that has to be taken has been well deliberated upon
and documented
for years, documented, but nobody takes the step.
Right. The government has to bite the bullet sometime there on subsidies as well. Let me ask you this. The last time in December, when the RBI intervened, they put a stop to all speculative activity there. They made a point that no speculative activity is there. A lot of those speculative players immediately went out after the RBI said. Do you think any risk at this, do you see any risk at this point that the RBI controlling the rupee may be sort of, as some people say, could be slightly unfair to corporates? Do you see that charge being leveled against the RBI at all? Do you see any validation?
No, I think if RBI is intending to arrest speculation, everybody would like to agree with that. But we have to be little practical. For example, RBI took this step where they said that rebooking of contract will not be allowed. Now, if I am an exporter and my buyer says that you put on hold after giving me an order, then I have to go for the rebooking of the contract. And for that, if you are penalizing me, where I have no control over an external factor, that is little unfair. So I go along with the RBI if they are intending any measure for speculation. But then they have to see the flip side also of these measures. Coming to the gold import, I think there is very little elbow with the government. They have already increased the duty. If you are looking at the restricting gold import, it will encourage smuggling. Because on the one hand, they have the duty benefit, on the other hand, the restriction will work on that. To me, it seems when the global demand is down, price is the key issue. And for that, you have to increase the competitiveness of Indian export sector.
Right, right.
For that, I think the first and the foremost measure is to bring down the interest rate across the board, try to provide some interest subvention to the export sector. And I think if the government takes these steps, it will help the competitiveness of export sector as a whole.
Point taken, sir. Last word on the show, sir, to you, Pinaki Chakraborty. We have little time, 30 seconds or less. Is RBI simply delaying the inevitable? Do you see the rupee sliding further, given the fact that our CAD is all over the place and external factors? Is RBI simply delaying the inevitable? Do you see the the rupee crossing the $57 mark as well in the near future?
Well, I don't want to predict about the mark, but,
no speculation
but
on the show as well.
Definitely,
it
will slide further. It will slide further. But I think the problem lies in the fiscal front. I think you have to make immediate fiscal corrections. And the point I'll agree with Mr. Sahai that you need to bring the interest rate down, which creates climate for investment and growth. And automatically you will see that your current account deficit coming down.
Right. Point taken, sir. That's all the time we have. I must thank all my guests before I sign off. Pinaki Chakraborty, Ranjan Dash, as well as Ajai Sahai. Of course, the fundamentals, my expert panelists say, of the economy are still very strong. No need to hit the panic button just yet. Of course, we have to bring interest rates down. The government has to do that, and that might stimulate the demand and the growth in the country. That's all the time we have from the big picture tonight. Till next time when we come with another issue and a new panel of guests, this is Athar Khan signing off, saying good night. Thank you for watching.